that the biggest mistake you can make is thinking you control the market. You don't. You only control the money you risk. I want you to be brutally honest with yourself. Why do you lose money? It is rarely because you picked the wrong stock. It is almost always because you mismanaged the position. Jesse Livermore lost his fortune 4 times not because he was wrong about the trend, but because he was wrong about money management. He finally realized that speculation is a defense game. The goal is not to get rich quickly. The goal is to survive long enough to capitalize on the few massive opportunities the market offers today. We strip away the noise and focus on the bedrock of his lasting success. The 3 non-negotiable principles of money management that separate the survivors from the speculators who flame out. Losing money is a choice, and we are here to stop making that choice. This change starts with a fundamental shift in how you view the capital in your trading account. Your trading capital is not spending money, it is ammunition, and the master speculator never wastes a single round. Phase 2 is the breakthrough definition. Livermore finally understood that money management is not an afterthought. It is the foundation of the entire trading system. He defined his capital not as personal wealth but as ammunition for the market war. He knew he only had a finite amount of psychological and financial resources to endure the market's randomness. The first principle emerged directly from this realization: capital preservation. If you protect your ammunition, you ensure you can always fight the next battle. Losing money is the ultimate failure because it robs you of your ability to participate when the high conviction trade finally arrives. This discipline demands a complete psychological detachment from the dollar amount you see on the screen. Do you view your trading account as a spending account or a professional war chest? Comment war chest if you agree. The true cost of a small loss is not the money lost, it is the capital that cannot be used for the next perfect trade. Principle 1 is capital preservation achieved through patience and inactivity. Livermore's ultimate rule here was simply never rush. He understood that the biggest drain on capital is commissions and small cumulative losses from low conviction trades. He often sat in cash for weeks waiting for the clear, undeniable trend to emerge. This waiting conserved his firepower. He calculated the opportunity cost of every dollar. A dollar tied up in a sideways struggling stock is a dollar that cannot be deployed into a massive breakout. By embracing inactivity, he minimized exposure to randomness and maximized his capital's potential for high-impact trades. Preservation means resisting the urge to gamble just to feel busy. Once the market gives a clear signal, preservation moves into calculated deployment through scaling. Never risk a large sum until the market has proven your initial small risk correct. Principle 2 is controlled position sizing achieved through test entries. Livermore never entered a full position immediately, no matter how confident he felt he would initiate a small test trade, typically a fraction of his total planned position size. This small trade served two purposes. First, it was a cheap way to gauge timing. Was the market ready to move now? Second, it protected his primary capital. If the market immediately went against this test position, he would liquidate it instantly for a minimal loss. This small loss was a tuition fee, a cheap price paid for knowing the timing was wrong. If the test trade moved quickly into profit, the market gave its validation and he would then confidently scale up. Do you use small test entries or do you commit 100% of your desired size? Immediately comment your method below. The final and most critical money management principle is the immediate severing of ties with any failing trade. The mistake is not losing money, the mistake is letting the loss develop into a major tragedy by confusing hope with strategy. Principle 3 is ruthless stop loss execution, the foundation of all risk control. This is the unbreakable mandate. Livermore realized that large losses are caused by one thing: emotional hesitation. The moment a trade moves against you and crosses your predefined invalidation point, your opinion is wrong. The capital management rule here is absolute. The first loss is the cheapest loss. By cutting the loss instantly, you cap your financial risk, and more. Importantly, you protect your psychological capital. Hesitation introduces hope, the most expensive emotion in the market, which leads to the catastrophic failure of not executing the planned exit. Your stop loss must be placed and executed without debate the moment the trade is initiated. This principle directly forbids the amateur's most destructive habit, the psychological failure of chasing losses. Averaging down is the gambler's reflex, not the speculator's strategy. It turns a proven mistake into a double error. This takes us to the deepest psychological trap, which violates all three principles. Averaging down. Livermore learned this lesson repeatedly and painfully. When you buy more of a losing position, you are committing more capital to an idea the market has already declared wrong. You are not managing money, you are performing emotional revenge trading against the market and yourself. Averaging down doubles your exposure, triples your psychological stress, and eliminates your remaining capital preservation ability. Livermore's system categorically forbids this sin. If you are wrong at price X, the rational response is to reduce exposure, not double the bet. Never try to buy a lower price simply to lower your cost basis. Instead, focus on preserving the capital for the next high conviction trade. The true way to commit more capital is by doing the exact opposite of averaging down. Reward conviction with capital, punish errors instantly. This asymmetric response is the core of smart money management. The successful counterpart to principle 2 is the art of scaling up. This is where money management creates leverage and conviction. If your small test entry principle 2 proves correct and the position moves into profit, you begin adding to your position in stages. You are averaging up, using your profits as validation for increased exposure. This strategy ensures that your largest commitment of capital is placed into a trade that is already confirmed and moving in the line of least resistance. Scaling up leverages conviction, protects your risk exposure, and generates the massive asymmetric returns that fund the small unavoidable losses. This is smart money management in action, using the market's own validation to deploy more ammunition. Do you find it harder to take a loss or to hold and scale into a large winner? Comment your biggest struggle. Livermore's greatest success was a masterclass in the systematic application of these three principles simultaneously. He didn't predict the crash. He simply managed his money when the market told him the trend was broken. The 1929 market crash serves as Livermore's ultimate case study in money management. While everyone was losing fortunes, Livermore was making them because he rigorously followed his three principles. He observed the signs of market weakness and used capital preservation. Principle 1. By sitting mostly in cash, he initiated small test short trades. Principle 2. As the market showed vulnerability, when those tests moved into profit, confirming his bearish thesis, he executed the scaling up strategy. Principle 2 and 7. Critically, he placed absolute stop losses. Principle 3 on every short position, ensuring that if the market had rallied unexpectedly, his losses would have been minimal. He didn't guess the crash, he simply managed his risk and capital perfectly when the inevitable trend break occurred. These principles must be adapted to the speed of today's digital environment. The speed of the algorithm demands that your money management rules be automated and executed before the emotion can interfere. Phase 9 is modern automated money management. Today, the market is faster and more unforgiving than ever, requiring you to automate. Livermore's principles. Capital preservation. Principle 1 means defining your daily or weekly drawdown limit and walking away once hit. Position sizing. Principle 2 requires using fixed dollar risk calculations for every trade, not guessing the number of shares. Stop loss execution. Principle 3 must be done electronically immediately upon entry, a hard stop that executes without your mental consent. The speed of the market means that relying on mental stops is a catastrophic failure of money management. Your written plan must translate instantly into automated limits to defend your capital against human emotion. We conclude with the realization that money management is the ultimate competitive advantage. You came here looking for a trading secret. You found a simple truth. The secret is survival, and survival is money management. We have unveiled the bedrock of lasting success. Livermore's 3 key principles. Money management is not about profits, it is about survival, conviction, and preserving ammunition. Principle 1 demands patience. Principle 2 demands calculation. Principle 3 demands discipline. The trader who consistently adheres to these rules will naturally outperform the trader who chases price and gives into emotions. Stop focusing on what the market might do. Focus on what you will do with your capital. When the market inevitably moves against you, your greatest edge is not analysis, it is the unwavering discipline to manage your money perfectly. Trade defensively. Manage your risk ruthlessly, and your money will finally start working for you. Go forth and trade systematically.